Greetings. My name is Kyle Soley. I'm a partner here at Reed Smith. With me is my colleague Sebastian Watt, also a lawyer here at Reed Smith. Sebastian and I are going to be doing a four-part video series on federal tax reform, the 2017 federal tax reform, and how it affects state taxes. Our first two videos are going to be on the transition tax and the actual cash repatriations that companies will likely be doing after the transition tax, and how that affects state taxes. And today, in particular, we're going to focus on the transition tax and the cash repatriation generally. And we're also going to talk about factor representation, how in your apportionment factors you may be entitled to and may get factor representation. So with that, I'm going to turn it over to Sebastian to kick us off.
Thanks, Kyle. So as Kyle mentioned, and as many of you watching this video are probably aware, the tax reform legislation that was passed by Congress in December of 2017 introduced a one-time deemed repatriation on certain U.S. taxpayers' foreign earnings of foreign subsidiaries accumulated but not distributed since 1987. Now, many states are going to include a portion of this deemed repatriation in their state taxable income. And this is because most states start with federal taxable income in determining their starting place for state taxable income. So in determining whether a certain state is going to include a portion of the deemed repatriation in their state tax base, the first question is whether the state conforms to the changes made to the Internal Revenue Code by Congress last year. In answering that question, states conform to the Internal Revenue Code in one of two ways, generally. First, a number of states conform on a rolling basis, so that is, they'll automatically conform to any changes made by Congress to the Internal Revenue Code from the time they were enacted by Congress. These states are rolling conformity states. The second way that states conform to the Internal Revenue Code is static conformity. These states generally conform to the Internal Revenue Code as of a specific date.
I'm going to put in a little spoiler alert, Sebastian, before we go on. At the very end, in our last video, we're going to say that even if you think you're a rolling conformity state, so a lot of people are like, we know all this. This is old hat. We've seen 15 different teleseminars and webinars and all this on this. We know all of that stuff, but stay tuned. We have on our fourth video, we say you may think you've got a rolling conformity state, but don't have a rolling conformity state. Anyway, I put it back to you. I just want to give folks sort of a sneak preview as to what we'll be doing at the end.
I'm looking forward to that session.
Okay.
So the second way that states conform to the Internal Revenue Code is static conformity. In those states, legislatures need to update their conformity date to the Internal Revenue Code to incorporate changes made by Congress in December of 2017. So if you're in a rolling conformity state, or a state that has updated its conformity dates that conforms to the tax reform provisions, you might have some of the deemed repatriation might be included in your state tax base. So the next step is determining whether some of that repatriation is actually included in the state taxable income. And there's three things to look for in making this determination. The first is if the state provides for less than a full dividends received deduction for subpart F. Massachusetts, for example, provides for a 95% deduction for dividends. Now, Massachusetts courts have said that that dividends received deduction also applies to subpart F income. Because the deemed repatriation is a form of subpart F income, the Massachusetts dividends received deduction should apply so that you can deduct 95% of the deemed repatriation and not all of it. So you'll be left with 5% of the deemed repatriation in your Massachusetts state.
Still could be a lot. I mean, 5% of an enormous number could be, significant.
Could be a lot, especially if you're a multinational headquartered in Massachusetts with significant Massachusetts operations. The second thing to look for is a state that provides for a dividends received deduction, and it might be a full dividends received deduction, but it has an ownership percentage requirement for that deduction. Maryland, for example, requires a taxpayer to own at least 50% of its interest in a foreign corporation to get that dividends received deduction. And Maryland, by administrative release, has said that their dividends received deduction also applies to subpart F. So in Maryland, in order to deduct the deemed repatriation from the state tax base, you need to own at least 50% of the foreign corporation.
And again, there's a little bit of tension there, because if you own less than 50% of the foreign corporation, it's more likely that foreign corporation isn't unitary. We'll talk about that in our next video on on the transition tax and deemed repatriation. But there, if it's not unitary, if your subsidiary is not unitary, then you wouldn't include the income at all. So there's this tension. It's interesting. You want to be 50% or more in Massachusetts to get the deduction, but if you're less than 50%, you may also be okay because it would be not unitary.
Right, that's right, for Maryland, yeah. The third thing to really look out for, and there's likely going to be a lot of sort of audit controversy around this issue in our view. Several states have got statutory provisions that require a taxpayer to add back expenses related to dividends that are excluded. So for example, if you have $100 of dividend income in the tax base, and that dividend is subtracted or excluded by the state might also require you to add back or disallow expenses related to that dividend. For example, if you took out loans at the U.S. level, the theory is the deductions related to those loans, the interest deductions, are fungible. A portion of those deductions are related to generating dividend income, because you might have used that loan to acquire a foreign operation or to fund a foreign operation. So the theory is that by excluding the dividends, you should also have to exclude the expenses. Most state statutes don't provide for a mechanism in determining exactly how much of the expenses you would have to exclude. Connecticut has an interesting proposal that would deem the expenses related to an excluded dividend to be 10% of that dividend, which means that for every $100 of deemed repatriated income that you included in your tax base and then subtracted from the Connecticut tax base, you'd have to also disallow or add back $10 of expenses. So it's sort of a sneaky way to tax some of the deemed repatriation. So now I'm going to turn it over to Kyle and to talk about the actual repatriation.
Yeah, so at the federal level, right, the whole idea here is we're going to have this transition tax, and then the income will essentially be previously taxed in a way that will not cause a federal tax result, a federal tax effect, when the actual cash is paid back under the view that the tax has already been paid. The issue that folks should be sensitive to is that that is not the result that necessarily plays out in the state tax world. And what we're going to look at in particular is the California example, because it's a good example that shows that you have really sort of the opposite result in California than the result you have federally, at least insofar as the timing and the mechanism of income inclusion is concerned. So we've got an example here of a U.S. parent that has a CFC and that had $1,000 of the income that is included at a federal level under the, it's included at the transition tax in the federal tax base. California, and that's done under the mechanism of the new Section 965 of the Internal Revenue Code. California doesn't conform to the new Section 965, and the FTB has told us that the California is not going to apply. California does have a mechanism to include Subpart F income, regular, I would call it regular Subpart F income, has a mechanism to do that. The FTB, at least so far, has taken the position that the income that's deemed to be Subpart F income under Section 965 is not going to be included in that formula for California purposes. So I guess in a way that's good news, I suppose. But the issue then is, okay, what happens in year two when you actually bring that cash back? Now again, federally, that's a non-event, but in California, it is an event. First of all, California does not conform to Section 959. In other words, it will not treat it as previously taxed income because it's previously taxed for federal purposes. And because California is not going to include it, it's not going to treat it as Subpart F, it won't be previously taxed for California purposes. What does all that mean? To boil all that down, California is going to treat that cash repatriation as a dividend and include it in taxable income. Now, California has a 75% dividend received deduction, but that leaves you with a 25% non-deductible piece. The other thing, this kind of relates to your discussion about Connecticut, California has a foreign investment interest offset provision, which essentially disallows interest deductions, either essentially based on the proportion of your investment in foreign entities for substantially similar reasons to those that you described. But when you cut through it, often taxpayers that have significant foreign dividends and a foreign dividend deduction will end up having a significant portion of their interest disallowed. So the question that comes up is, well, what can we do about this? And one of the issues that we think you need to look at is factor representation. So when we say factor representation, what do we mean? Well, the whole idea of formulary apportionment, of taking your business everywhere and apportioning it by reference to the apportionment factors of that business, comes out of various cases, like the container case and some language from the Mobil Oil case at the U.S. Supreme Court. And the idea is that those apportionment factors have to reflect a meaningful sense of how the income was earned. So in our view, take California as an example again, if you include 25% of those dividends in your base, you need to include 25% of the factors in the apportionment. And we're not just talking here, when we say factor representation, we're not just talking, I'm going to include the dividends themselves. We're looking at the underlying activities of the subsidiaries that generated the earnings and profits that out of which the dividends were paid. So it's much more. Obviously, you have to make a lot of sales and have a lot of property and payroll in order to create $1 of dividends, a lot more than $1 of each of those items. So that's what we're really talking about here. And this isn't without precedent. So not only has the U.S. Supreme Court alluded to it in a couple of cases, but some state Supreme Courts in Maine, Wisconsin, and Vermont have actually dealt with this issue favorably for taxpayers and have said the taxpayers are entitled to it. And even California, again, getting back to California, even California, the Board of Equalization, even California and even the Board of Equalization has allowed taxpayers factor representation when dividends are included in income. So it's something to look at, and in that regard, I'm going to turn it back to Sebastian, maybe take a little bit of a deeper dive technically on how that factor representation would look.
Thanks, Kyle. I think the first point to make is that auditors might disagree with factor representation. If it's not provided by statute or regulation, it might not be 100% clear to them that it's allowed, even though it's clear from a constitutional level that factor representation is required. So you just want to make sure that you've nailed down and applied factor representation, correctly and thought through the issues. So turning to that issue, you kind of need to look through, there's several things you need to think through in determining your factor representation. The first is what generated that income? What activities in your CFC generated the income? Was it ordinary business income? Was it royalty income? Those sorts of determinations might impact how you source the income and whether it's ultimately included in your sales factor denominator. Second issue is whether you can look through to the activities of disregarded entities. You might be thinking, yes, of course, you always look through to the activities of disregarded entities as a general matter of taxation, but you might want to think through some of the practical implications of having your foreign operations in a separate disregarded entity. You might have accounted for them differently for financial reporting purposes or for local reporting purposes. So there might be some practical considerations there in gathering the data you would need to take a factor representation position. Kyle mentioned this earlier. You might get to apply a multiplier to the income that you're including in your U.S. tax base. For example, if your deemed repatriation was $100, that $100 is presumably after deduction for cost of goods sold, paying employees, all the costs of doing business. But sales factors are typically based on gross receipts. So, for example, if you included $100 of deemed repatriation income in your state tax base and your profitability on that income was, say, 20%, you might be entitled to gross your sales factor up by $500, much more than the actual income inclusion. Another thing to think through is whether you can apply historic factor formulas. So, for example, if your apportionment today in a state is 10%, but a number of years ago it was only 1%, and the state applied a 3-factor equal weighted formula, you might be able to apply that historic formula in apportioning your deemed repatriation income. So there's just a few of the issues you're going to want to think through when taking a position or when preparing for audit. Another huge issue with taking this position that you have to think through is whether you can gather the data you would need to support the generation of income going back to 1987. I mean, that was the year where Mel Gibson was still keeping our streets safe from drugs, and Microsoft had just released the first Windows version of Excel in the same year that I came into this world. So, it was a long time ago, needless to say.
It's a good year to be in high school.
Right. And the data might not be available. That said, there are federal tax forms that are required to be prepared with respect to your foreign operations. For example, taxpayers are required to file a Form 5471 with their federal tax return for each foreign subsidiary. And if you have records, tax records going back to 1987, you might be able to look to those as a starting place in determining your factor representation.
So this is not just looking back to those old years to determine, this is not just looking back to those old years to determine what your percentage was in those old years, but rather to go back 30 years and take 30 years worth of sales, and assuming that it's foreign sales, put those 30 years worth of sales in the denominator. Or maybe in California, for example, take the 30 years worth of sales and take the 25% that ends up being included in your tax base, and take the 25% of 30 years worth of sales and put that in your California denominator. Well, that brings us to the end of our first video. Thank you for joining us. On our next video, we're going to be continuing our discussion about the deemed repatriation, the transition tax, and we're going to be talking about how the unitary business principle plays out and some interesting twists on that. We hope that you will watch that video as well. Thank you for joining us.